Are you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so I think we're still. Hello. Welcome, everybody. Welcome, everybody. Maybe I'll share it.
So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
hello, everybody. Welcome to another Capital Gains Tax Solutions Mastermind Masterclass. Every single Friday, we are here. We are live on YouTube, live on typically Facebook, Twitter, and other channels. And we want to welcome you if you're watching this live replay. Thank you so much for part of the community, part of the movement to help people create and preserve more wealth beyond just the 1031 exchange or additional ways of exit planning. Each week we talk about live deals that are coming up, as well as frequently asked questions or answer questions here live in our mastermind. And if you're interested in joining us, you can go to capitalgainstaxsolutions.com, and that'll give you an opportunity to join us. And if you are a business professional, high net worth clients who are exiting highly appreciate luxury real estate, businesses, cryptocurrency, stock positions, we want to invite you here as well. We believe that we're fight for freedom of the wealth in America, and as a part of that, it's that $84 trillion has transferred from one generation to the next, and whether or not it's going to transfer in tax at a high rate, and maybe not as efficiently as it could be, or it can be deferred to other businesses and other investments, and it can grow the economy, which ultimately actually leads to more tax revenue. It's part of why 401ks and IRAs and 1031 exchanges even exist. And it's also the essence of what the Deferred Sales Trust is a way to delay the tax, incentivize us who own highly appreciated assets not to spend all the money, it back into businesses, into communities, into things that can actually create more jobs and create more tax revenue. That being said, we are going to be talking a little bit about building your dream DST team, building your DST dream team. But I am joined by some of those gentlemen that are a part of the dream team. We have Jake Miller, financial advisor, MBA, amazing individual. Jake, how are we doing today, sir?
Doing very well, Brett. Thanks for having me again. And it's always a pleasure to join this Deferred Sales Trust call.
Excellent. And we've got Pierce York as well. Pierce York is part of the team as well. He helps co-host the podcast. He is a real estate professional, Newport Beach area, commercial real estate and luxury real estate. Pierce, how you doing, brother?
Doing awesome, man. Going to have to get a little appointment, so we'll see what happens here.
Excellent. Be safe as you drive there. We also have Jake Carpenter. He's part of our strategic alliances. He's the financial advisor up in the state of Washington. Jake Carpenter, how are we doing, sir?
Wonderful. Great to be here. Good to see you all.
Perfect. So let's dive right into the topic at hand, which is building your DST dream team. Sales Trust Dream Team would look and consist of a group of professionals, and these professionals have knowledge and expertise in their various fields. I had the privilege of having Kevin Harrington from Shark Tank on my podcast, and he's also now in the new book, by the way, Building a Capital Gains Tax Exit, which was released yesterday. So you haven't picked it up. There actually is a short extension. Amazing news. We'll talk about here in a few minutes on that. But the point of that is Kevin building a dream team, right? And the dream team are those professionals that have a specialized skill set and various different niches that can help achieve. And this dream team works together to ensure that you as the client have the best representation, the best strategy, essentially creating like a family office environment, or if you hear a family office listening to this, the various experts work together to help you achieve an amazing transformational outcome. So what would a Deferred Sales Trust Dream Team look like? Number one, you would find a Deferred Sales Trust expert. What does that mean? Well, that would be a professional with extensive knowledge and expertise and practice, 10,000 hours of practice, ideally, in setting up and managing deferred sales trust. They would also be responsible for guiding the team, providing guidance on the best practice for the trust. And that would be probably one of the many professionals. What would be the second professional? The second professional is probably the most important professional, and that is the tax attorney. And this tax attorney would be essential to the advice of the legal legal outcomes if certain actions are taken, right? And also to ensure that if it's actually a audit, that there's some defense and there's experience with that defense, right? Is wherever you're trying to go, that the person who's going to help you get there has helped a lot of other people do that. The next part, and not only that, but the people they've helped do that, they've been through the fire of the audits, which is an amazing part of the Deferred Sales Trust. Thousands and thousands and thousands and thousands of closes over 27 years, over 24 no change IRS audits, no change, no findings. It's worked for just about any asset class you could think of. But you want to make sure you have that tax attorney that in case the IRS does come knocking, you can show that you properly reported, everything was done in the timely manner, and there was no mistakes. Okay. Number three person on the team you have is a financial planner. You would want to have a financial planner. Now, a financial planner would be necessary to provide guidance on the financial implication of the trust and to help that the clients develop a long-term financial plan that's based upon their risk tolerance, that's based upon their needs and desires, and it's looking at a critical perspective, outside perspective, right, to make sure that things are. The next person you actually want to have in your dream team, which we may not have mentioned as much in the past, but I think it's really important, is a real estate broker that understands this. Understands what? The Deferred Sales Trust. In other words, you wouldn't work with a commercial real estate broker who didn't understand 1031 exchanges, right? You'd go, I don't think you're quite qualified to help me because I'm selling, a $10 million apartment complex and I have, 45, 180. But if you don't understand those time frames and those rules, then you're probably not qualified. So the same thing is true. Part of your DST team, you want to make sure you have a commercial real estate stands the Deferred Sales Trust, in particular, to make sure that they understand how to structure within the transaction, because the Deferred sales trust cannot be executed. The first part of the transaction is, gone into escrow. The buyers work through contingencies, and the deal is closing. And so we got to make sure we have that. I guess I would add to that, you would also want to make sure you have an escrow company that also understands this. We've times when we've done deals, and they would ensure us that escrow is going to make it happen, but they didn't know what they were doing. They thought they would know. They get it confused with the Delaware statutory trust. And so making sure you have a part on your dream team as a real estate broker and escrow is so important. The next part of your dream team would be the accountant, okay? Accountant, your CPA is necessary to help you with the tax filings and to ensure the trust is in compliance as it pertains to everything. Let me back up. Your tax filings would be that CPA, but there's really two CPAs. There's the CPA tax attorney who created the structure. That's the original creator, and he helps your CPA to properly report the installment sale. But you want to make sure that both parties are in communication. They're part of the dream team overall. As circumstances with your business tax returns, with your LLC, C corps, S corps, all of those things are we want to make sure that they're weaved in with the deferred sales trust as seamlessly as possible. Okay. Number 6, and we're winding it down here. We're going to have 2 more here. Next part of your dream team would be estate planning attorney. So estate planning attorneys have to do with typically passing your assets via a living trust. If you don't have a living trust, get a living trust. Make sure that the assets go, instead of going through probate, they go to and to whom you want the assets to go to. So we want to make estate planning attorney ensures that the promissory note, which is what you own, weaves into your living trust. And the last part of your dream team is you want to have a trustee, a third party unrelated trustee who's responsible for managing the trust and ensuring that it's in compliance of the terms of the promissory note, and essentially is staying within the guidelines of what's been laid out by the tax attorney. So all of these people are part of the dream team. Hopefully that doesn't sound too overwhelming. Actually is an opportunity to see that with a lot of tax, $32 trillion in tax, or debt that the government has, we all have a tax problem, which means we need an army, we need a dream team to help execute that. So I'm going to open it up for Jake Miller to opine on any of the above for today. Jake, what are your thoughts? What are the things that you'd even dive in more into?
Literally, I guess we should answer, why is it important to have a dream team? I mean, essentially, a lot of times the deferred sales trust is in consideration. It's because you're having the largest transaction of your life. Or perhaps it's not the largest transaction of your life, but it's rather significant in nature, which means that you need to level up in regards to your advisors, your support, your counsel, your help, right? And that's why it's important and critical that we bring this dream team to the table, that all your advisors, think of it as like the round table, like King Arthur. Why did he make a round table, right? So that everybody's looking at each other as they're making decisions, and so that they all have a common goal in mind. They're all looking to the center at one thing, or literally we're all on the same page for client, that we're accomplishing the goal, that we don't all have ulterior motives, that we don't all have like, hey, let's solve everything with one strategy. Oftentimes, as Brett mentioned, there are several things that need to be accomplished. And although the deferred sales trust might be this keystone strategy in the middle, and a lot of others are like around or next to or adjacent to the deferred sales trust, we need to ensure that everybody understands what it does do, what it doesn't do. We need to make sure that everybody's on the same page as to what the reinvestment goals and objectives are, what the client's time horizon is, what their income needs are. And we need to definitely all support the client in asking questions that they may not to ask. Like, how does this help with estate planning? How does this help with risk mitigation? How does this help with income goals? The deferred sales trust is just a financial tool. However, for it to be properly utilized and optimized, it does require a team.
Very well said. I want to open up for Jake Carpenter. Jake Carpenter, for the investment options that people are wondering, what are the options? Can I be active? Can I be passive? How can I diversify this? What does it look like, Jake Carpenter?
Yeah, so each individual has their own goals. Some of them want to be active, some of them want to be passive, and some of them want to be a little bit of both. And so that would dictate what kind of investment strategy we have. But The beauty of the deferred sales trust is you can invest in anything: stocks, bonds, mutual funds, hard money lending. You can go into syndications. You can partner up with your trust and do some more real estate deals that you're actively involved in. And one of the best things about working with guys like Brett Swarts and Jake Miller and some of these other guys like Pierce is that we all love and appreciate real estate and alternative assets. So Jake and I both, we call each other Jake Squared, but we're both big advocates of real estate. And yes, we can go into stocks, bonds, mutual funds, ETFs, whatever else you want to go into, but we're also are big supporters, and we also have channels that can allow our investors to go into real estate syndications, real estate deals. Brett's got a lot of access to be able to help them get back into actively working in real estate deals while continuing to achieve capital gains deferral. So in essence, you're taking this big tax bill and you're putting it back in your pocket so you can go redeploy into an active real estate deal, passive real estate deal, stocks, bonds, mutual funds, really whatever is going to balance out the overall diversity in your financial picture. Because most of these assets are coming to us through the sale of businesses, real estate, and other kinds of hard assets. And then the sellers don't want to necessarily go right back into the stock market because they've got other assets there. Yep. So you got to look at the three-dimensional diversification picture and really work with a guy like Jake Miller and Brett Swarts to create three-dimensional diversity, not just stocks, bonds, and mutual fund kind of diversity, but tax diversity, asset class diversity, location diversity in the country. Maybe you want some assets outside of the country. These guys are all folks that can help you do that.
Very well said, Jake. I'll do it for Pierce. Pierce, what do you think the biggest objections are to the Deferred Sales Trust? And for those that are listening right now or coming in brand new, that they're wondering, like, what are some of the fears or challenges that we face before people meet us and I had a chance to talk with them? What would you say, Pierce, comes to mind, number one?
I would say number one is it sounds too good to be true. And that's a hard to overcome because I would say most experiences prove that it sounds too good to be true. It's too good to be true. There's the one exception that I found where it literally is just such an amazing strategy. It's powerful. It really is to how people think about exiting their assets, anything that's highly appreciated. There's so much flexibility, so much freedom, so much ability to create, preserve, grow wealth. It's so elegantly designed. Not even just the exit, but all the tax strategies that work in conjunction with it that you can then go ahead and deploy. It's so efficient, and I would say it's the most powerful tax control strategy that's out there.
Yeah, and we'll say, and I'll also answer that to that objection, and then I'll pass it to Jake to answer an objection. We found that is probably the number one thing. He would know about it, or even if he'd heard of it, he'd had a lot more clients that have done it. And that's kind of the biggest one at first. And so we always encourage people to, we'll talk about the evidence and the track record and all of that. I kind of touched on that before, but instead of just thinking of that, which we have a perfect track record, thousands of closes, billions of assets sold collectively with the Deferred Sales Trust tax returns who created this 27 years ago, all of that. But also third-party national law firms, 55-plus-year-old CPA firms that have done tens of thousands of tax returns. And so it's there. All the evidence is there, but yet emotionally tough to say, well, I still know will it work for me, or someone might feel like they're the only one using it because they're not exiting 5, 10 a day. And so it emotionally can be tough, and we get that, and you should be skeptical and cautious. But let me give you, I think two stories. I'll start with the first one is David Young. In fact, David Young is also in the book with Jake Miller. I did promise I would mention this again. Building a Capital Gains Tax Exit Plan. We have a free Amazon Kindle download. If you go right now and you're listening to this live, we extended it one more day for the free download, 300 plus page book. Jake Miller's in the book. David Young's in the book. I have a few chapters. You have Kevin Harris from Shark Tank in the book. Go to Amazon to download your Kindle version for free right now. That being said, David Young is an amazing individual, and it's interesting. I'll read from the book, but he just quickly his background. He previously held a position at PIMCO, and he was a part of a management group in London. He built a team of 25 investment professionals, over 200 clients' accounts, approximately 50 billion in assets across UK, Europe, Middle East, and Africa. And he lives in Irvine, California, a Newport Beach area, and he's taught finance and investment courses at UC Irvine, certified financial analyst. He's just a really smart guy, 30 plus years. And we asked him this exact question. And I want to read a little bit of the excerpt of what he said here. And I think it was interesting the way he put this. And he says, it's the two edges of the sword that comes with wanting to protect something. A great business idea, intellectual property with a patent, and so on, have certain legal and other protections. So no one can take the really good idea and duplicate it, which is important. But perhaps more important, they can't take the good idea and mess it up. So in a strange way, when you are protecting anything, it also places some limitations on its broad use. Not everyone can see it or access it. It's not perfectly transparent or out floating around on the internet. Although we are live streaming, we're talking about a lot of the high level stuff. We don't get into the proprietary stuff. But the way he puts it, it says we expect everything to be Googleable, right? Or we can just Google all of it and just figure it out on just some YouTube channel, right? Well, this isn't that, at least not in terms of the detail, because there's no way to do that and make it that broadly available without protecting it to make sure it stays and is done right. We have this conversation about these asset portfolio where the nature of it is that the investments must perform within a range. This range is fairly generous and there's some flexibility. And he's talking about the investments of it. And he goes on to talk about that. And I think the biggest thing with David is David did a 2-year due diligence. David and his team of legal professionals, his dream team, flew back and met with the tax attorneys on a whiteboard, mapped it out for 2 days, talked with national law firms, talked with clients, talked with banks, looked at this thing every which way before they became a part of the dream team. And they can be a support to the financial advisors like Jake Miller, Jake Carpenter, who work with us as an additional piece. And so what we say to everyone who's listening to this right now, that if you're skeptical and you're cautious, you should be. But if it's good enough for David Young and his legal team, after 2-year due diligence, extensive research, and he's one of the best in the world at what he does, managing some of the biggest, net worths in capital in the world for his clients. Is it good enough for you, me, and anyone else who's listening to this? And that's usually the story that helps people emotionally move past, well, my CPA didn't know about it, or even my tax attorney didn't know about it. We know that groups like a David Young, who are world class, have done extensive due diligence. That doesn't mean to say that you don't continue to do diligence. We just want to help you to move forward with us, which brings me to Jake Miller. Jake, how do we work if someone wants to research it with us? How do we work with our engagement agreements?
Absolutely. On a conditional basis. That is actually rare and singular in the industry, meaning we don't charge you anything unless at the end of the day, after the sale, the proceeds actually enter the Deferred Sales Trust. And at that point, we all become a team. So literally, this could be hours and hours and hours of education, conversation, and work to make sure that we have the structure perfect and optimized so that upon the day of sale and after, we accomplish the expectations that we all have. And we do all of that without charging anything up front. And we do that because we are very confident that we filter out the people that this is not eligible for. And typically, we identify that there's enough tax pain that this should be a good thing for you to consider and do. And in the very beginning, understanding that, we then feel like it's an investment on our side to put in the time and effort to educate You, your team, your advisors, your counselors, your spouse, your Uncle Joe, anybody that's important to help you make that decision, we feel like it's a good investment on our side to invest that time in you, because we want you to be comfortable. This is kind of like a marriage. We want you to have your eyes wide open before the actual ceremony, so that afterwards you can have faith and confidence that we are together with you to the end.
Yep, makes sense. And Jake, who is it not for? Like, who would you say, either, just give us who wouldn't want to use this?
Absolutely. Great question. I want to tell you, I had this amazing client. I still have this amazing client, Miami. And she sold some real estate and bought a $3.5 million Lamborghini. For her, we did not do the deferred sales trust because she just wanted to buy something that had no business purpose or reinvestment purpose whatsoever. It was all personal in nature. She did take a few selfies for her business in her Lamborghini. That was mostly for self-gratification, didn't really have any marketing purpose. So we could not justify a business reinvestment with the Lamborghini. Other individuals who just want to buy a personal home or something personal in nature, we cannot justify a business trust for something that is considered personal for personal enjoyment and pleasure. But should the individual wish for reinvestment purpose to put the proceeds of the sale into another investment, or maybe an exotic car rental company, or maybe whatever, right? Like a work living space, what have you, within certain parameters and proper documentation. A lot of other things are possible as long as we can justify it for reinvestment purpose. Other people who this is not a good fit for, if you're looking to leave physical, tangible assets to your heirs, like a mansion, let's say that there's a mountain cabin and you want to leave that to your great-great-grandson. Well, upon your death, your heirs get a step up in basis, depending on how it's owned, as long as it's not owned in a corporation, something like that. That is not a proper use of the deferred sales trust, because you want to leave something physical and tangible, not just the value of that thing. You want to leave something physical and tangible. What the deferred sales trust does is it allows you to leave the value and reinvest the value in other things to diversify your underlying investment. So if a specific thing to your heirs, don't use the deferred sales trust necessarily, because there are other methods that might be more efficient for that. However, should you want to leave the value of that thing to your heirs, the deferred sales trust, if you don't want the kids and the heirs to fight over who gets what, or fight over do we sell or do we not, if you want to sell that now and today, you can receive the proceeds into the deferred sales trust, defer that transaction to the future, not pay any taxes now, and leave the proceeds to your heirs via creditor rights and the promissory note.
Perfect. No, it's good, Jake. And by the way, just so you know, you can also take a portion, you say, hey, I want to buy that Lamborghini for $3.5 million. I'm selling a $10 million business. You can take a distribution immediately on the $3.5 million, pay your tax, go buy that. And the other amount, the 6.5, can go into the deferred sales trust. So it doesn't have to be all or just one. You could also do a partial, deferred sales trust with a partial 1031 exchange. And there's times when we're bifracturing a 1031 to do some diversification. Most of the time, we're typically doing that because either A, they found a deal that made sense, but they have some extra boot left over, and that's why we're doing the deferred sales trust. Or B, they have what's called a debt over basis challenge, which would be your debt is exceeding your adjusted basis. And so we need to do what's called a debt replacement on a partial Delaware 1031, typically into a zero coupon deal. A little more advanced there, but just let you know, these are some of the things that we're going to consider. By the way, we have a live deal in Southern California. This gentleman owns an asset on the beach, and it's really funny. We're talking this exact thing. He says he's always had a dream of selling in Newport, is where he owns this asset, and moving all of or some of a portion up to the Del Mar area and buying a big mansion on the beach there, right? Big house. So it's always been his dream, and also maybe spending some money. And so we were going through this exact conversation. I was saying, well, look, what do you need for that? Maybe instead of selling your about $30 million asset and buying a $20 million deal, why don't you sell the 30 or pay the tax on the 20? Why don't you sell the 30, defer all the tax, but take about a 5 or 7 or whatever it takes for the down payment, pay tax on that, and use that to buy the asset. And then we can debt snowball all of the proceeds, all of the interest that it's earning. And so there's ways to move, think of it like in a Rubik's Cube. That's where we get the team involved to see what's most efficient. And so we'll see what happens, but that's a new deal that just came up this week, and it tends to be People want to spend money and that's their money. But I also said to him too, what's your current cash flow? It was really interesting. His asset value was about, 30 or so. His cash flow wasn't that great. And I said, well, what if we can triple your cash flow? What would that mean for you? Right. And he said, that would mean a lot. And I go, well, do you think you could, do the things you want to be doing? He's like, yeah, I think I could do more of what I want to do with that. And so even though someone might think they want to buy something all cash, like a home, you might say, well, have you considered that for every dollar you take, especially in California, it's about 30 to 40% or more you're going to pay in tax. So another way to reverse engineer that would say, would you go right now and borrow at 37 to 40% to buy your thing? And they go, oh, no way, right? I go, yeah. And interest rates have gone up on home sales, and let's just say 5 or 6%, maybe 7, if depending on the size of the deal. Would you much rather borrow at 5 to 7 versus paying 37 to 40% to get that dollar out? And he said that's a good point. And so these are the things that will work with you and we'll map out to try to make it as efficient as possible. That being said, I want to open it up for questions. Or Jake, do you want to add something before we do that?
Well, perfect time. I was just going to ask. I was going to say that there's a very relevant question. According to what we were talking about literally 5 minutes ago, somebody was asking, "Hey, this dream team sounds fantastic. However, it could be a little intimidating. A lot of smaller business owners that might have a qualified transaction, meaning that it's over $1 million or at least $1 million of actual capital gains, where they're going to pay like $200,000 minimum in taxes, right? They're saying, hey, what if this was just like a mom and pop, whatever, we're selling a warehouse? And do I need a dream team? I've always done everything myself. And it's not necessarily that, I don't want you to feel, I guess if I'm going to comment on this, and I want you to comment on it as well, Brett. I want to say that it's not necessarily that, hey, we're going to go all be celebrities and we're going to be in the spotlight, even though we call it a dream team. But for this transaction, it does require subject matter experts to guide you through the reinvestment process, specifically if you want to invest in items other than marketable securities. Now, even though we are putting this dream team around you, if you're an individual who has a very calm retirement experience, you kind of want to just drift off into the sunset, make sure that everything is taken care of, that you have your monthly income, all these other things. We go through that process to help establish your goals and objectives. And oftentimes that always includes your income needs, right? And that might be a very low touch in regards to our actual activity with you. There'll be monthly reports, there'll be quarterly reviews, there'll be little things like that. But for other individuals who are like serial entrepreneurs who buy and sell, and this is just one transaction out of many, we have a much more active participating role where we have to help you with the structuring of every future deal that the trust participates in on your behalf. I don't know if you want to add a little bit more to this dream team and how we fit into the needs of every deal.
Yeah, it's a good point. Yeah, and I think it is. In fact, we have clients from every spectrum where it's. I guess I don't know if bomb pop's the right word. It just maybe just simpler and lower key, right, and a little more under the radar. And so first of all, we're very easygoing, right? And to the extent that our clients, are hustling and bustling and doing new deals, we're moving quickly with them. And to the extent that our clients are wanting a little bit slower pace, we definitely move that pace as well. So we always customize our solutions to our clients. That being said, depending on the direct client relationship, typically there's like one main point of contact, like day to day or week to week or quarter to quarter, depending on who brings in the client, who has that relationship. And that person, let's say it's Jake Miller who's bringing in the client, that would be the main point of contact with his team. And then we are supporting the team, right, as it pertains to the trust and our role. And so it's not unlike probably what you've experienced, perhaps, if you have an IRA or a 401k, or if you've done even a 1031 exchange with a real estate broker, you're working with the broker who's typically working with the exchange accommodator and is working on the details in the back end and the transaction coordinator and escrow. I mean, all of a sudden, if you're doing a transaction, there's multiple parties that start to come in. There's the person who's doing the financing, but your broker be your main point of contact, who is on your behalf representing you to make sure everything is going as smoothly as possible. That's the same way we work. So it's not as if you have to answer to just, so many people all the time. We make it very, I guess, user friendly, if you will, on the day to day, week to week. And some clients we're talking once a week. Some clients are once a month. Some once a year. Once it's kind of set it and forget it. In the beginning, it is pretty intense in the sense that we're going to make sure everything is lined up, proper planning. But once the trust and the funds hit the trust account and the investments are made and the payments, automatic payments are set up, it's really like clockwork, and until we're reviewing some of the investments maybe once a quarter to see how the performance is doing, and or the tax returns once a year. And so, yeah, I think that's, hopefully that answers the question, Jake. Anything else you want to add to that?
No, I think that was very helpful. At the end of the day, we call it a dream team just because we're identifying that perhaps you need new people that have an expertise or subject matter experience different than the people you already currently know, which is why people are watching this recorded session that we're having, or that they're here presently right now as we're talking, so that they can learn from us something that other people have not really told them in detail or explained at length.
Yeah, and we also might be good to like define like what we mean by dream team, not just like, hey, we're special and we're cool. Like it's really the 10,000 hours of study and practice of our expertise. And so, Jake Miller, for example, was a part of over, I think, 10,000 CPA groups, and of that, the top 400 of looking and monitoring and or vetting out different tax deferral strategies. And it's part of how he found out about the Deferred Sales Trust. And so he has a unique skill set and expertise because he spent the hours doing that. My unique skill set is I happen to just grow up in the real estate business, developing and building houses with my parents in the Bay Area, California, and then fell in love with commercial real estate, investing in multifamily brokerage at a place called Marcus and Millichap, and have helped clients sell and move into Delaware's 1031s and of course Deferred Sales Trust over the years. And so what we try to do is just bring our unique gift that we've worked and been blessed with, but worked really hard to develop, to the team, so that if you need expertise in commercial real estate, you have it. Expertise in financial planning and in stocks, bonds, and mutual funds, you have it. Expertise in structuring even deals. Jake has been known to put together deals and negotiate and help. And so these are the things that we bring to the table. And some of our clients are like, I got it. I know the funds I want to go into. I know the investments I want to go into. I'm entrepreneurial. Some are like, hey, I really want to take advantage and unlock some of the expertise that everyone has. Each client's a little bit different. I have one client, he's in Texas. We did 37 million of land sales last year. And I mean, if you can think of a guy who wants, control and knows exactly what he's doing and the strategy, that's him. He's a serial real estate entrepreneur, buys and develops land. He was formerly a broker. He's done incredibly well. And I'm like, hey, how do I support you? Right. But he knows exactly where he's going. Now, as a trustee, I've got to review it and I've got to look at it and I've got to prove it. That's part of keep the integrity of the trust. But he's very focused on that. He doesn't necessarily need to access the dream team. Others, though, they want and they decide to do that. But it's never, one or the other. It's a little bit of both. But that's part of what we provide as the service. So hopefully that answers the question, Jake.
It does. Nope, that was very helpful. Thank you. I
Should
think you were mentioning before that it's a good time.
Yeah, good time to open it up for questions. So anyone have any questions? You can either put it in the chat. You can also just unmute yourself and ask questions. We're happy to questions, challenges, objections, all of it. This is the perfect place to do it. Sometimes we actually have clients with us who can answer and speak on their experience, and sometimes it's just us sharing those client stories as well. So you can go ahead and unmute yourself or put it in the chat. Any questions or thoughts, and we'll answer that.
So we have Edwards. We have Edward. He's asking about how much is the service? I think we can go into fees and things, right, Brett?
Yeah. Pierce, we haven't talked to him in a while. We've been talking a lot. Why don't Pierce come in? Why don't you give a general overview, Pierce, of what are the costs that are involved with the Deferred Sales Trust?
Sure. So there's three kind of sets of fees. The first is a one-time fee that goes to the law firm who creates the trust, provides lifetime audit defense. That's about 1.5% of the gross on the first million, and then 1.25% for every million after that. And then there's an annual reoccurring fee of about 2% that's split up between the trustee and financial advisor, and just very miscellaneous things like a tax return and so on and so forth for the trustee and the financial advisor. Now those get kind of like shifted around based upon what asset you're in and whatnot, but it doesn't exceed that 2% of the proceeds in the trust. So that's the structure of a real basic structure. And
Perfect. Yeah, and I'll break it down on a deal. So let's imagine you're selling a $1 million asset tomorrow, has a $1 million gain. It'd be $15,000 would be the cost time to the tax return. That covers lifetime audit defense. Now let's imagine $985,000 hits the account tomorrow. And on that amount, it would be about 1.5 to 2% would be on a recurring basis that would be charged to the trust. Now, the goal is typically to return 6, 7, or 8%, depending on your risk tolerance, net of that recurring fee. Okay. So let's say it was at 8% on 985,000. It's almost 80,000 of interest. Of that, we're going to hopefully earn about another 15 to 20,000 above and beyond that 80,000 in any given average year. Okay. And then you'll net to about 80,000 and it'll pay the trust the other about 20. I'll pay the fees for the trust. Okay. So that's the general fees. There's a tax return of about 1,300 or so, a financial reporting fee of $250. And if you're interested, you can go to capitalgainstaxsolutions.com and you can schedule a consultation. And we're happy to also send you to the fee schedule. But the better question to ask too would be, how do I make this an investment and not an expense? And that's where you can partner with the trust to go buy more real estate. Hopefully you dollar cost average and buy deals at a discount, either real estate or stocks. And you're diversifying, you're paying off debt, you're getting your powder dry to be able to capture and get into deals when they make sense. These are the ways to grow your wealth. You can get a new depreciation schedule to offset some cash flow if you buy, like say real estate with the trust. And then you can get additional upside should that real estate perform. So these are things that we unlock to make the 1.5 to 2% an investment, not an expense. And then if an audit does come, no charge, 100% covered by the law firm for the audit. If you hire them, should you hire them, which you probably would because they've had a perfect track record. So that being said, those are the fees. Does that answer the question? I think it does. Jake, you want to add anything else to that?
Typically, when we engage with somebody, we actually do an analysis of, hey, what would you pay if you had to pay taxes? 30 to 50%, sometimes depending on the scenario, on the state, all these other things, right? At a minimum, you have the 20% capital gains tax plus the 3.8 possible Medicare tax at a minimum, right? And then we compare that to the attorney fee of 1.5 on the first million, 1.25 on everything after that. And that's for the lifetime audit protection and everything else. Very quickly, we usually put the money to work in reinvestment because it's a business trust, right? You're using this structure to defer the taxes so you can reinvest with the gross proceeds rather than paying taxes and using what's left over, right? We charge, as Pierce mentioned, no more than 2% between the trustee, financial advisor, management of the assets, management of the corpus of the trust. And sometimes that's more Brett charging, sometimes that's more, financial advisor, whatever, right? It just depends on who's managing assets, everything else.
And also clarify that too. So some people get confused. If they joint venture partner with the trust and go do their own deal, it's still 1.5% no matter how, to 2%, no matter how and where you invest the funds. Whether you're joint venture partnering with the trust, whether you're going to passive real estate, whether it's 100% in the stock market, no matter how and where, it's about 1.5 to 2% each and every year. Important to understand. Also, if you can eliminate some estate tax, right? That's another 40% for the legacy as well, which is powerful. And then hopefully you buy that real estate deal at a discount, right? Because you didn't do a 1031 and overpay. You waited, a year, 6 months and a day, whatever. You waited until you can negotiate a nice deal, or you bought smaller deals at a time. We did a $13 million exit for our client in San Diego. They develop property. So they develop car washes. So they buy the land for about $500,000. They develop for about $3.5 million. So they're in it for $4 million. They sell it for $13 million. Well, if they did a 1031, they have to buy something for $13 million. They're like, we don't do that. We don't buy car washes for $13 million. We develop them for $4 million and sell them for $13 million. And so the deferred sales trust was perfect for them because not only did they pay off the debt, diversify the wealth, get liquid, but they've been waiting for this market to shift. And now it's shifting. And now they're going to find opportunities to do it all over again in a tax efficient way. And so you can partner with the trust, still defer the tax, still build more wealth, and then you can roll it back into the trust again on promissory note number 2. So these are all ways that we unlock and make the investment, make the deferred sales an investment and not an expense. I think the second question came up there, Jake, and I'll pass it to you.
Yeah. So when would the trustee overrule the grantor? I think to understand or to properly answer this, we should actually talk about the life cycle of the trust. And as far as the life cycle goes, before the trust actually is alive, let's say that baby's in the womb, right? So we have our conversations, we meet and greet, we get a good feel for each other, we explain, we educate. Part of education is understanding that in the beginning, before the trust is born, there is an asset that is being sold. An asset or a business, shares, whatever, right? Let's call it a building. Let's say it's a warehouse. The warehouse that is being sold gets moved into the trust prior to the sale.
But like how far in between? Like right at close of escrow, Jake, or like months before?
Usually at close of escrow, like right before, like the day before, the day of, like literally right before, because we want you, if we want you to have every possible option to not do this if you so choose, right? And so even in letters of intent and in contracts, the purchase agreement, everything else, there's language that says that you can sell it as it is, as it's currently owned and titled, or that you could possibly sell it through this deferred sales trust. That's important because it leaves all the options available until you actually sign with wet ink or whatever, right? Now, when you move it into the trust, this is kind of like a pre-sale before the sale. There needs to be an exchange of something of like value or equal value. And most commonly, that's a promissory note. In fact, all the time, that's a promissory note. All right. So you exchange the property for a promissory note. You are now the proud owner of a piece of paper, an IOU, a promissory note, and the asset is in the trust. That allows for a non-taxable transaction. Now the asset in the trust gets sold by the trust to whoever is buying it. There's proceeds that flow into the trust. This is all done at arm's length so that you do not receive what's called constructive receipt, which means that you do not own or you have not received the actual cash proceeds. That means that you don't have to recognize that as a taxable transaction for the year. That's very important. That allows us to.
By the way, it's the same way that 1031 works, Jake, right? I mean, you can sell the asset and the proceeds go to the qualified intermediary and they wait there for a period of time where you give up some control for 45 to 180, depending if you identify or de-identify or properties close. So think of us like a long-term 1031, but no replacement requirement, no timing restrictions, no like kind replacement investments. It's really a nice way. Now, do you give up some control? Yes, you have indirect control. So let me kind of answer the question and I'll let Jake finish. When would a trustee say no? And I'm, by the way, I'm a sales trustee. So people ask me this hypothetical question all the time. And it's typically goes like this. Well, what if I want to put all of it into Bitcoin tomorrow? Would you say no to that? And I'd say, yeah, I would say no to that. Here's why. Because your risk tolerance was, this score and you're going off the rails. So if you wanted to go off the rails, we'll send you your money back and you pay your tax and go put it all into Bitcoin. They go, oh, okay, well, yeah, I don't really want to do that. So this is the typical scenario. Even, hey, I want to put it all into Apple stock. We would say, well, your risk tolerance, even though that's a great company coin, that would be something where we would say no to because it's over concentrated into one single stock, right? That may not fit exactly what your risk tolerance is. And so we do have to have some, it's an art and a science here with your risk tolerance, your income needs, right? And the investments to try to do our best as a fiduciary to you to pay you back your money plus the rate of return. So hopefully that answers the question. And hopefully that makes sense. Jake, want to add anything else to that?
I do. So I want to also compare it to, I want to express the importance of becoming a promissory note holder against the assets or the corpus of the trust, right? So in one sense, we are giving up ownership of an asset that then is going to be sold by the trust. And that allows us for the deferral of the recognition of taxes. It's important to also recognize that the creditor has creditor rights. Now, these are legal rights that allow the creditor some measure of control without being considered constructive receipt or ultimate or taxable control. And let me put it that way. That's not really a phrase, but it tells you the potential outcome. So if you are a homeowner, how many of us here in this room on this panel discussion have been a homeowner with a mortgage? And you are considered the proud homeowner. Thank you, Jake, for raising your hand. You are considered the proud homeowner. Brett, everybody else, right? You're considered the proud homeowner, and you have full rights and whatever of being a homeowner until you decide to not make payments or to do something that crosses the boundary of the requirements of being a homeowner and your obligations. At that point, who is it that actually has ultimate legal rights to the asset? If you don't pay your mortgage, the bank or the lending institution that wrote the note has ultimate power and authority to seize the property and to liquidate if needed, or to make decisions should you not live within the bounds of what you're supposed to do. The same thing is true with the trustee. The trustee has to take on a fiduciary responsibility of the corpus of the trust. This is a business trust for reinvestment purpose. He has to align those reinvestment purposes based on what is allowed by the creditor. And should he ever go outside of those bounds, the creditor has ultimate creditor rights, power, and authority. But of course, the fiduciary, typically in Brett, I mean, you use an example, an extreme example, like a very possible, dangerous, out of the normal parameters established by the creditor of what to invest in. But similar in nature, should the creditor wish to invest in something that is considered criminal or outside of compliance, etc., then you would also say no.
Yeah. Yeah, but we can also build in, the promissory note to be paid back sooner, right? So some people might say, well, 10 years seems like a long time. Like, I'm just getting to know you guys. The very fact that you don't know me as the trustee is what gives the integrity of a third party unrelated trustee. Like, it can't be your secretary, can't be your nephew, can't be, a friend of yours, can't be your college roommate, all this stuff that creates what's called basically related parties, even if it's not just family. And so as a part of that, we can build in structures and protections. By the way, you have 24/7 access to view funds online, funds are removed without your signature, but we can build in, instead of 10-year notes, it can be a 5-year note or a 3-year note or a 12-month note, knowing that the balloon payment's due in 12, and you have a legal, right to be able to take it back and pay your tax. And you can always renew it and refinance. It does cost more money if you're doing it in shorter terms, as far as some hourly fees that are paid to the law firm that does this. But other than that, it's very flexible. That being said, what other questions do we have? I think we nailed that one as much as we can.
I was just going to add one more piece. Go ahead, Pierce.
Oh, I was going to add something that was brought up a little bit, earlier. Also along with this dream team, Brett, you had mentioned like possible 1031, in the parallels with it. There are a lot of times where the DST can come in and save a failed 1031 exchange. And I think it's also important that you have a good QI company that is that provides options, because if you haven't caught on to it yet, what the Deferred Sales Trust does is it provides options, and those allow you to maneuver and position yourself so that you can take full advantage of the opportunities that arise. And if you're not in that position, or you're pigeonholed, right, you have limited options. It makes it really difficult to maneuver and pivot and take.
Yeah, we literally save 1031 exchanges all the time. And if you're listening to this, make sure you get with us before you even list your property, because if you send your funds to a qualified intermediary that is not a part of the dream team. By the way, another part of the dream team would be a qualified intermediary that understands, knows, trust, and gets the Deferred Sales Trust, so that when your funds are with them, you have the option to do a regular 1031 or a Deferred Sales Trust. The worst thing you can do is to not have someone on the dream team who actually blocks you. And we have people that call us and like, oh, I didn't know it mattered that I could use any qualified intermediary. Like, no. Not every QI company wants you to know about this. Not every broker wants you to know about this. By the way, I happen to be a commercial broker. I still am. Still help people do 1031 exchanges. We still work with the Jakes. They're here to do Delaware statutory trust. So that being said, make sure that they are a part of the team, right? You want to have options and flexibility. But yeah, we routinely save failed 1031s. But if your funds are with a qualified intermediary that is not cooperating, you're in what's called 1031 jail. And I've had people millions and millions of dollars in tax, just pay it because, and I did say, well, I guess you learned the lesson. I wish you would have met me sooner. So if you're listening to this, please connect with us and say, hey, I want the 1031 Rescue QI company. I want to make sure I know who that is. Just to send us an email and we'll connect you with them to make sure that you're in good hands. That being said, what other questions do we have? We're actually up against kind of the hour here. So I want to just see, does anyone else have any other questions? You can unmute yourself now. You can also put it in the chat and we will answer them the best we can within 7 minutes.
There's one more question, just asking how long can you use a DST for?
Good question. As long as you'd like, honestly, and typically 10-year increments, and every 10 years you can renew for 10 years. If you do a DST plus, it's based upon your life, it's your lifetime. You could always it can also be unwound and you can pay the tax, but then your children can be the beneficiaries of the DST plus. On the DST 1.0, which has more flexibility, your children can step into your shoes. They don't get a stepped up basis, but they can step into your shoes and continue the tax deferral. Most of our clients, if they keep the principal intact and just live off the interest payments. So let's say it's a $10 million exit and it's at $800,000, 8% interest per year. They're typically going to live off, up to $800,000 because they don't want to dip into the principal, right? They want to just keep that corpus intact, which has hopefully an extra $3 to $4 million that's working for them. So, but you can also do shorter. You can do fully amortizing loans. You can have it pay you out more. Some clients do that where they'll have an amortizing loan over 15 years kind of thing and just keep paying it out. And just at the end of 15 years, it's out. It's really up to you. Part of why we like the DST 1.0, it's a little bonus here, is because it gives you more flexibility for the payments to be adjusted over time. So these are all the little things that will work with you to make sure it's customized to you.
And then can the DST receive installments?
Yeah, so the DST can receive installments slowly over time. In fact, Jake Miller and I just closed a case for a client in Florida who sold a business and is receiving installments slowly over time. So what's neat about the DST is it can be one DST and multiple promissory notes from either different asset sales, crypto, primary home, business, or it could be even the same business sale, except you might have it earn out or you're staying on, and slowly receive some of those installments as they come in, and or a property that you sold on an installment sale, and you want to slowly receive the installment sales proceeds in to the trust. We just did that for a deal in Monterey as well. So yes, it can receive installments.
And as a realtor, this is from Paul, by the way, when a seller has agreed to pay a commission to sell a property, and the day before closing, the property is put into the trust, would I still receive my commission, Brett?
Of course, yeah. And so there's going to be demands from the bank. If there's a loan, there's going to be demands for commissions. Escrow is going to have fees. It's all going to be on the closing statement, and it's also a part of the buyer removing contingencies and paying. These are all intertwined. And by the way, there's things called assignment of sales. Is typically what we're doing here, assigning the interest. We're typically not doing a two escrow transfer kind of thing, right? It's typically assignment, and so it all happens. And you get paid just like the bank would get paid.
Very nice. So literally the DST doesn't interrupt the process necessarily at all. If anything, it liberates the client to be able to invest with the gross proceeds minus attorney fees rather than minus taxes. I would think at the end of the day that, again, rather than thinking of grantor rights, which are kind of like a different kind of trust, we need to understand creditor rights, that through the investment and management of the trust process, typically the creditor must dual sign with the trustee on all transactions. And so you're never actually left out of what's going on inside of the trust. Simply put, there is a trust and a trustee in between you and the assets for purposes of the deferral process, and that's what makes this a legal trust.
Absolutely. With that being said, Pierce, if people want to find you, where they can find you.
Yeah, you guys can find me at Living in Newport Beach, California YouTube channel, or kingdomluxuryrealty.com.
Excellent. Jake Carpenter, if people want to find you, where can they find you?
You can reach me at Jake, Jake at carpenter.capital. That's CARPENTER.capital. Or you can hit the website www.carpentercapital.llc.
Perfect. Mr. Jake Miller, people want to find you, where can they find you?
strategictaxsolutions.com, as well as 1-800-773-1848.
Amazing. And if you want to connect with me, go to capitalgainstaxsolutions.com. Check out our YouTube channel. Find me on LinkedIn as well. Facebook, Instagram, Brett Swarts. It's BRETT SWARTS. So appreciate everyone out there. And again, book today or get the book tomorrow because you'll pay for it tomorrow. Today it's still free on the Kindle version on Amazon. Just go to your Amazon account, look up Building Capital Gains Tax Exit Plan. And thanks so much, everybody. We'll talk to you again real soon. Bye now.